listen-only mode.
Hello, everyone. Thank you so much for joining us here at CPA Academy. Very excited to have Green Donation Consultants here. Jessica and Diane will be your presenters today, and I'll be handing it over in just one moment. Before I do, we're going to do a few housekeeping items. Make sure everything's working for you, the audience. Make sure that audio is coming in. Make sure you can see that first screen up. All the basics should be working for you. So let's get started. If you wouldn't mind going to the GoToWebinar control panel, we'd like to check in with you. There's a questions pane. Many people are typing in, letting me know where they are joining us from. So if you hadn't already, say hello. Let us know what brings you here today, what interests you in this course, what part of the country or world you are joining us from. If you have questions for the Green Donation Consultants team, please ask away. We will be sending them a full report later today with all of your questions. You will also see a handout pane in that same area. There are 5 handouts for this session, so please feel free to download. We also made those available in your account at cpaacademy.org. This is a 1-hour course. It's eligible for 1 CPE or CE for enrolled agents. In order to get that credit, you need to do 2 things: attend this full session and answer the polling questions. Those polls will be launched periodically. You just need to select the radio button that best fits your answer, submit, and you are good to go. We'll do our best to get your credit processed a little later today. You should see it in your account by tomorrow. We'll also be recording this session, so if you miss anything, a review, share with a colleague, we will send you that link in the post-webinar email. So my screen is filling up. We have a big class here today. We have New York, Texas, Chicago, Tennessee, Florida, let's see here, Wyoming, North Carolina, Virginia. I cannot keep up. Colorado, thank you so much. It looks like things are working well, which is always my cue to step aside. So Jessica, Diane, thank you so much for being here today. Our audience is ready and the floor is yours.
Fantastic. Thank you all for joining us. I am thrilled to be presenting this webinar for you. An introduction: I am a CPA. I am subcontracting this position as CEO and CFO for Green Donation Consultants. I also run a small tax and accounting firm in Fredericksburg, Virginia, and I cater to individual and small business clients. So I came over to Green Donation Consultants, as I'll get into a little more detail later as to why I took on this role as CEO and CFO. But I will now let our co-presenter, Diane Scarborough, introduce herself as well.
Hi, my name is Diane Scarborough. I'm currently the Vice President of Production here at GDC. I have been an appraiser for over 14 years now. I started as real estate and transferred along with GDC over to personal property appraisals.
All right. So, Green Donation Consultants. We are the largest privately owned donation consultant agency and the largest personal property and materials appraisal firm in the country. The dream of this mission was brought about by Mayor Donkara. He is our COO. He has a master's degree in construction management. And given that he is not the CPA nerd that I am, he is not a presenter because he would be far too entertaining and dynamic for a CPA crowd. So that is why it is left to me to do this presentation. I was brought in as the CEO and the CFO as the partner for Mayor in this mission. Like I said, I have 18 years of experience in the accounting and tax model. I have worked in internal audit. I started out at KPMG, and I was brought in to shore up the non-monetary donations. This consulting model is to ensure that critical donations are received by nonprofits where they need to go, and to shore up the tax operations for these donations to ensure that accurate appraisals are produced by our staff. We have a staff of 20. That makes us the largest in the country right now doing these appraisals, and we run this company much like I have run my own accounting firm, which is with conservative principles and accuracy. So our vision statement, as I mentioned, is to support environmental change by bringing together construction management, appraisal, and accounting expertise to facilitate non-cash charitable donations of building materials and personal property to nonprofit organizations. So what personal property requires a qualified appraisal? If many of you are like me, in my 18 years of preparing tax returns and consulting, I rarely saw a non-monetary that required an appraisal. I had one client who had a piano they had appraised. And that was really the extent of my understanding of non-monetary. So this has been an interesting pursuit to dive in and see what the IRS requires. So the baseline rule is anything being donated more than $5,000 requires a qualified appraisal made by a qualified appraiser and the Section B of Tax Form 8283. So Tax Form 8283 is the form that has to accompany those 1040s that are submitted for individuals that are taking these non-monetary donations. So we look at cash corporations versus accrual. The major difference here to differentiate between is that the IRS allows for cash method corporations deduct the contribution in the tax year that it's actually paid, much like our accounting standards. The accrual method, the corporation can choose to deduct the unpaid contributions for the tax year. The board of directors authorize them if it pays them by the due date for the filing of the corporation's tax return. So that gives the wiggle room into the new year prior to the filing. For individuals, contributions must actually be paid in cash or other property before the close of the tax year to be deductible under both cash and accrual methods. So that's important as CPAs and enrolled agents to make sure that for individuals that they actually did donate this property by the close of the tax year. So yearly charitable contributions, limits for individuals and corporations. The IRS allows corporations to claim a limited deduction for charitable contributions made in cash or other property. We are going to refer to IRS publication 542 for deductions made to a qualified organization. A deduction cannot be taken if net earnings of an organization receiving the contributions benefit any private shareholder or individual. So that's important to note as CPAs, that we look and we make sure that these corporations donating are not benefiting any major stakeholders within that corporation. And the corporation cannot deduct charitable contributions exceeding 10% of taxable income. Just like individuals with the 5-year carry forward, corporations also who exceed this 10% limit may carry forward for 5 years, but it's lost after that 5-year time frame for both individuals and corporations. Let's go ahead and launch into our first polling question now right off the bat, just to make sure that we hit all of these. If we could please launch that first poll, that would be great.
Thank you, Jessica. We've launched that first poll. All right, thank you so much. Let's see here, about 50% say fair and about 39 saying good. We're going to close that poll now. Back to you.
Fantastic. Okay, going back into how net income is calculated for charitable contributions for corporations. There are some items that need to be removed from that calculation. I won't go into detail on these, but these are listed here to come to that 10% floor for deduction. So these should be reviewed closely for any corporate donations. We also, as CPAs and enrolled agents, the basis in these assets when donated by corporations is critical. Some of our corporate clients, for example, are hotels, where often the majority of their assets are fully depreciated. Now, this does not preclude donation. We have been able to work with corporations and clients where we can show how they can generate goodwill by bringing in videographers and advertising the donations that they are doing through Deconstruction. So in addition to donating the items to a nonprofit and doing a great thing for these organizations, they can also use this as advertising and marketing over the years to follow. And there are also building materials in the deconstruction process that can be donated that might not be fully depreciated or included on the balance sheet. Again, this is a very complex case-by-case situation with these corporations. And as CPAs, we need to really dive in there and study this out to make sure that we are advising our clients accurately when it comes to making these donations. So as I talked about, the power of advertising is an amazing carrot that can be used for corporate clients to get them to do these deconstructions rather than demolition. One of our major goals with our green mission is to divert as much material and property from the waste fill and the waste stream and the landfills as possible. So we can talk to our corporate clients, and what Green Donation Consultants is able to do is to dive into these corporate projects. And because we have put the work in ahead of time to find potential nonprofits to take this material, we are able to come in and work with the deconstruction crew and complete the project in a time very similar to a demolition. So often that is the major impediment for gatekeepers in the corporate world to do these donations of deconstruction rather than demolition, is that we could hold up a timeline by deconstructing. But Green Donation Consultants has dived in to finding partners and finding second and third and fourth nonprofits to take materials that perhaps a single nonprofit entity might not be able to take. For example, we did an interesting project up in Baltimore that was for a major spice manufacturer, and they wanted to donate some residential kitchens in this corporate office that they had used for the spices. So when we went in there to look at the appraisal, to look at how we would appraise these kitchens, we asked what would be done with the desks and the cubicles, and they said that was all set to be going into the dumpster. We asked if they could give us just 2 or 3 days to see if we could find a place for all of these donations. And our staff dove into this. They spent hours and in 2 days contacted over 230 nonprofits. And we were able to place with a total of 11 nonprofits to take almost all of that material, including shelters for battered women and children. There was a school for cognitively disabled blind students who were able to use 10-foot wall padded cubicles in part of their training for using mapping out areas. So we have been able to do an amazing amount of good by looking at efficiency and making sure we can get all of these items placed as quickly as possible and as completely as possible. So going back to the requirements for this, we look at the adjusted gross income. We know that for individual taxpayers, they can donate up to 50% of their AGI in non-monetary charitable contributions. For cash donations, that's up to 60% under the TCJA, but that is at 50% for non-monetary. And then contributions to certain private foundations, veteran organizations, fraternal societies, and cemetery organizations are listed to 30% AGI. So diving into what documentation does a qualified appraisal include? We need to know how you got the property. Was it by gift, purchase, bequest, inheritance, exchange, etc.? The approximate date you got the property, or if created, produced, or manufactured by you, the approximate date the property was substantially completed. Finally, it needs to be known the cost or other basis and any adjustments to this basis of the property held less than 12 months. And if available, the cost or other basis of property held 12 months or more. And as CPAs, we always remember that 12-month holding period requirement. And that asterisk at the bottom is important to note that this does not apply to publicly traded securities. So important points for donation consideration. A qualified appraisal includes the following factors. It needs to be made, signed, and dated by a qualified appraiser in accordance with generally accepted appraisal standards. Diane is going to dive into these requirements later in our presentation, so I won't go into too much detail there. But I do want to note that the third bullet point there, it needs to relate to an appraisal made no earlier than 60 days before the date of contribution of the appraised property. So as CPAs, when you see that 8283, check the dates on those and check the final donation date with the nonprofit and make sure that appraisal was made no earlier than 60 days, or that will not be considered valid. Finally, it cannot involve a prohibited appraisal fee. This is critical, and this is something that at Green Donation, we ensure that our appraisal fees are based solely on the amount of work and time that it is going to take to generate that appraisal. These can absolutely not be based on the value of the appraised material. And we also give a blind listing of inventory, what we take, to our nonprofit partners. So they only see the list of items that we have appraised. They are not given the values from the outset of how much those items of inventory are appraised. So this is one way that I'm trying to bring in more conservatism to this industry. And again, we'll talk a little bit more about that at the end. So information included in a qualified appraisal. So a qualified appraisal needs to include a name, address, and taxpayer ID number of the qualified appraiser. And if the appraiser is a partner, employee, or independent contractor, the name, address, and taxpayer ID of the partnership or employer. It also needs to include the qualifications of the qualified appraiser who signs the appraisal and a statement that the appraisal was prepared for income tax purposes. Again, this appraisal needs to be used just for income tax purposes, and there needs to be contractual language in the engagement packet between the appraisal firm and the client stating that that is the purpose of this appraisal. So we also need to include the date or multiple dates on which the property was valued. And going back to earlier in the presentation, I noted that these are required for donations of $5,000 or more in value. However, if there is a donor who gives to the same charity over the course of a year in smaller increments, if they aggregate to $5,000 through smaller donations, that requires the qualified appraisal to be done. So if there are 5 $1,000 donations given to a Goodwill, that would still require the qualified appraisal because in aggregate, it met the $5,000 threshold. The report also needs to have the fair market value on the date of contribution, the method of valuation, which we'll get into more detail in the next slide, and the specific basis for the valuation, such as any specific comparable sales transaction. So we also need to have a description of the property in sufficient detail for a person who is not generally familiar with the property. So as CPAs, if you are reading through this appraisal and you see that it says 5 boxes full of wood crap, you are going to know that is not sufficient detail. It needs to say 5 boxes full of cherry wood in this length, this diameter, so that someone like me who has no construction management background as a CPA can see that there is sufficient detail on which to base an appraised value. We need the physical condition of any tangible property. This is extremely important in value. This is an area that could be potentially manipulated if the physical description and condition is not accurate. The date of contribution, again, needs to be in there, and the terms of any agreement or understanding entered into on or behalf of the donor. That all needs to be included in the qualified appraisal. So we also, the type of agreement terms related to the appraisal, these are terms that temporarily or permanently restrict a donee's right to use or dispose of the donated property. Terms that earmark a donated property for a particular use, terms that reserve to or confer upon anyone any right to the income. So these are, again, the technical terms that as CPAs, and we see these non-monetary contributions coming in, we need to be cognizant of all of these requirements. So the value used for property donations. This is extremely important. We are using fair market value, and we need to make sure that this is a conservative fair market value. And that is one of the major goals of me coming into this organization as a subcontractor, is to shore this up and to bring the conservatism that we follow in the CPA industry needs to be brought to this personal property and material donations. So the factors used in determining FMV include the cost or selling price, sales of comparable property, replacement cost, and opinions of expert. So the original cost or selling price, this is a good indication if the purchase or sale took place close to the valuation date in an open market. Obviously, if it can be sold in an open market, that's a very accurate measurement of value. The purchase or sale was at arm's length. Buyer and seller knew all relevant facts. The buyer and seller did not have to act. There was no compulsion involved, and the market did not change between the date of purchase, sale, and the valuation date. That would be relevant if there was a huge shift in market demand for that particular piece of material or property. Sales of comparable property. This is a good indicator if we're reading through that appraisal. How similar is the property sold to the property donated? How close is the date of sale to valuation, arm's length, and the condition of the market at the time? Again, we are looking to stop the overvaluation and potential inflation of these non-monetary contributions. So we really need to look at the sales of comparable. We need to have a vast record and database of comparable properties sold at nonprofit organizations in used markets. Much more research needs to be done, and appraisal firms need to dive into making sure these comparables are accurate. The replacement cost methodology is appropriate when we need to look what it would cost to replace the donated property. Is there a reasonable relationship between the replacement cost and the FMV, and the supply of the donated property more or less than the demand for it? So replacement cost, again, we have to look at what is available on the market for replacement. What we want to avoid as working in the appraisal industry is appraisals where there could be a 10-year-old Viking range, where an appraiser might pull a brand new model as a replacement cost. In my opinion, that is not an accurate valuation. What needs to be pulled is what a 10-year model of the Viking range would actually sell for. So the value for property donations. When the opinion of experts, this needs to come in for highly selective donations that are rare and require an expert opinion, such as artwork is the example that always comes to mind. When you receive non-monetary contributions from clients like this, check the expert and make sure they are actually knowledgeable. Check their resume, see what degrees they've obtained, what training they've retained, and make sure that they are not just an expert on paper only. Check and make sure that they actually do this for a living and that this looks like a reasonable value. And when in doubt, like I've always run my CPA practice, and I get a Schedule C that just has some amazing assertions by a potential client about business costs, I need to verify, and I dive and I insist on source documentation. And I've always taken the conservative approach in that practice, and that has served me well. The same thing goes for these non-monetaries. As CPAs, we must be good gatekeepers to make sure that accurate appraisals are being utilized by our clients. And clients may not know everything that I'm presenting in this, and the conversations I hope to have with many of you after this. Our clients could be blindsided and really think that they were sitting on a mountain of materials that were worth a lot more, they were told that they were worth a lot more than they actually are. So it's our job as CPAs to use our common sense and use the resources that we have to make sure that we are submitting accurate appraisals to the IRS. A qualified appraiser, there's credentials that Diane is going to get into as well as minimum education and experience requirements. And I get into this a little later, but I just want to note that prior to 2018, appraisers of personal property were not required to have anything more than a high school diploma. There were many appraisers that were able to be grandfathered in prior to 2018 who just have high school diplomas. Now there is absolutely, I have amazing clients who work with just high school diplomas and do great things. That is not the point. The point is that there were individuals who were able to take a somewhat simple study course, very simple compared to what we as CPAs and enrolled agents go through. And they were able to earn designations that technically make them qualified appraisers. But when we look at their work, they are often 1 or 2 page appraisals, very few comparables. There's the propensity to inflate values to make clients happy. And this is something that as CPAs and regulators in the IRS, this needs to be tamped down. A qualified appraiser, again, I'm going to have Diane go into this in more detail, but a critical piece of understanding is that there is a difference between real property appraisers and personal property appraisers. They are 2 entirely different fields of appraisal knowledge, and somebody with a real property appraisal license is not necessarily ready to do a personal property appraisal. So a qualified appraiser will regularly prepare appraisals, demonstrate the verifiable education and experience, and they have not been prohibited from practicing under the IRS. And they need to be able to complete Form 8283, Section B, Part 3. Again, the 8283 is the documentation that the appraisal firm produces. Okay, I'm going to turn the presentation now over to Diane. But before doing that, if we could launch our second poll question, that would be fantastic.
Perfect. All right, we will launch that poll. That is now up. We'll give everybody about a minute. All right, we're about 95% responded. This last couple of votes in, and we will close. And back to you.
Okay, Diane, take it away.
All right. ISA, the International Society of Appraisers. This is just one of several appraisal organizations. It happens to be the one that I'm a member of. They're acknowledged by the Appraisal Foundation, as are others. And part of being a qualified appraiser is that you have to be a member of one of those appraisal organizations. Now, although Jessica was going through the qualified appraiser and qualified appraisals for the IRS, there aren't really a lot of things that are required of us. But having a membership to these appraisal organizations, they do require as a member that you must maintain their standards. So there's a little bit more that we have to do in order to maintain our membership, but they don't watch us. I guess what I'd be looking for. They do have specific requirements as far as the appraisal is concerned. They have a certain format that they require us to follow, as well as things that they need to be included in each of those sections of the appraisal. And it's quite extensive for them. The cover document has a total of 26 items that are required to be included. This is things like the date of the report, the inspection date, the objective of the appraisal, your scope of work, and those types of items, as well as an additional 12 items to be included if they're applicable to the project that you're doing. In the body of the report, there's an additional 11 things that ISA does require that are contained in every appraisal. and it includes descriptions, like Jessica was talking about, clear descriptions of the items that are being appraised, photographs of the items, identification of the market that we use to determine the fair market value. And then there is also the addendum for the year report, and that has another 8 items that are required, like the glossary, the bibliography, the qualifications of the appraiser. Also, something required by IRS is that our qualifications are in the appraisals. The IRS has recently started requiring the personal property appraisers to follow USPAP. So as a personal property appraisal, we have to follow the ethics rule, and that rule is put in place to ensure that appraisers promote and preserve public trust inherent in appraisal practice by observing the highest standards of professional ethics. Another part of USPAP to understand is that they only require that appraisers complete the same standards as their peers. So if everyone is doing the bare minimum, then all appraisers are only required to do the bare minimum. And that's where we want to kind of raise the bar to provide more than just the bare minimum. We're also required to follow the records keeping rule. So in that rule, we're required to maintain all of the information pertaining to the appraisal, everything we gathered, all of the information we analyzed, the markets we researched, all of the comparables. We need to be able to redo that appraisal just using our work file if necessary. And we're required to keep that for a minimum of 5 years, and also 2 years after any litigation if there is any. There is also the competency rule. If you look into a potential assignment and you don't think that you're going to be able to perform it and have credible results, you're required to either decline the assignment or do whatever is necessary to become competent in order to complete it. Now, if you do decide to take that route, you're also required to state in the appraisal that this is what you did so that you could complete a competent appraisal on that assignment. USPAP, the Uniform Standards of Professional Appraisal Practice. The IRS has, sorry, I was rereading. Scope of work is the next one. The requirement of the scope of work is you have to identify the problem that needs to be solved. You need to identify what you need to do, the necessary steps in order to solve that problem. So in a charitable donation, you need to determine that the value you need is the fair market value, and that the necessary scope of work is what market you need to address. And you need to disclose all of those steps in there. The jurisdictional exception rule, this one just states that if there's any law that goes against what's written in USPAP, then that part of USPAP is no longer valid. We no longer have to follow just that specific part if a certain rule doesn't comply with it. There are also 2 standards that apply to personal property appraisals. Standard 7 talks about the development of a personal property appraisal, and there are 6 additional rules in there that we're required to follow. And Standard 8 is in regards to reporting the personal property appraisals, so basically the results. And that contains 4 additional rules that need to be followed. The appraisal process starts with our initial inspection of the property, either in person or via desktop. We'll come out to the property and inspect all of the items being considered for donation. We'll take photographs, we'll take notes, note the condition, measure anything that needs to be measured, as much information as we can possibly gather on those items. We actually have developed an application that we have on our tablets where we can take a photograph of an item and then enter in the description and the condition and the quantity and all the information about it right there. And it will send a PDF to us that has everything there together. So you have your photograph, you have your description, you have your quantity, and you have your condition right there in the same place. For desktop quotes, we'll sometimes do that for out-of-state projects. Just to give an initial kind of idea, we'll look at the photos and information that's provided to us, and then if they decide to proceed with the appraisal, then at that time we'll go back at a later date and do an actual inspection. Once the inspection has been completed and we have all of the information here, an appraiser goes over all of the photos and all of the information we gathered, and will provide an estimated fair market value range and a cost of the appraisal, because we want all of our clients to be able to have all the numbers in front of them and make sure that this is something that's going to benefit them and be good for them before they have to pay any money out of pocket. After we have been engaged to create the appraisal, we'll begin our research and documentation. We reach out to the nonprofits periodically after a donation has been made and request the donation receipt or a contemporaneous letter from them with a listing of all of the materials that they accepted for donation. And we do not actually start the appraisal until we have that from them, because our appraisal will match their list exactly. Once we have that in hand, then we create a list, and it'll match the donation receipt and the letter exactly. Each item will have a number that corresponds with our photo addendum, and a description of the item, the quantity, and the fair market value. With household items, there'll additionally be a number of corresponding to the comparables that we used. So that way, when somebody's looking at the appraisal, they can look, okay, here's the photo that I'm looking at. This is what the description of the item is. This is how many there are. This is what it's worth. And this is how they figured out that that's what it's worth. With building materials, because they're not widely bought and sold in use condition, we will sometimes utilize a builder's software recommended by the IRS in their audit technique guide. It's called the RS Means. The software, we can enter all of the specific information for the project we're doing, and the software will value each individual item based on the current building costs in the subject's marketing area. And then we can apply depreciation using the age life method. The final report can be quite lengthy for us. They can range anywhere from 30 to even over 200 pages in length, depending on the size of the donation. The cover letter requires all of the information for the ISA checklist that I was talking about earlier, and it's separated into sections. We have first the appraisal assignment, and that will describe what the appraisal is for, which would be for a tax deduction in this case. The scope of work, the amount and type of information researched, and the analysis applied in the assignment. So that would include the markets that we researched and how we analyze them and determine the final value. The appraisal methodology is where we list out the different types, the sales comparable, the replacement cost, why we used the one that we used, and why we didn't use the ones that we did not use. There will be the statement of values, which is a conclusion and a total fair market value for all of the donated items combined. The privacy statement is a standard privacy statement that's required by ISA, the glossary, the bibliography, general assumptions and limiting conditions, and then we have the USPAP certification statement. This is something that is required to be in all appraisals. We will also include a PDF of all photos and information taken during the inspection report. So we include our actual inspection reports in the appraisal, as well as all the photos that we took. And we have the appendix, which lists out a listing and description of all of the addendums that we have also included. Addendum A would be the listed donated items individually and valued, just like I was talking about earlier with the image numbers and the description and the quantities. Addendum B will be the donation receipt and or the contemporaneous letter provided by the nonprofit, which also contains a list of the materials that they accepted for donation. It's not actually required to be in the appraisal, but we like to include it so that it's right there and everything's together. Addendum C will be the comparable sales that we use to determine the fair market value of each individual item. And then the final item would be the appraiser's curriculum vitae. If it is an appraisal of building materials, so if an entire structure was taken down and donated, then Addendum A would be the RS Means report that I spoke about earlier. Addendum B would be the contemporaneous letter from the nonprofit, which again will include a list of the materials that they accepted for donation, removed and taken back to their warehouse. Addendum C would be any public records with information about the property, the size of the property, the types of materials that it was built with. Addendum D will be the tax roll for the property, so the same type of information, just general information about it, how many bathrooms, stuff like that. And Addendum E will be our inspection report of the notes that we took when we went on site. And then again, finally, the appraiser's curriculum vitae. And that is also a requirement by the IRS to have our qualifications in there.
And if I can jump in, this typically requires the paper copy filing for CPAs and enrolled agents. There's not a lot of our tech software, and the IRS typically doesn't allow this large of a file to be filed electronically. Okay.
Yes, and as I was...
Oh, go
sorry.
ahead. Go ahead, Diane.
I was just going to add in there that, again, with what you were saying with the attachment, in some cases the appraisals are so large that we can't even send it through email, that we have to send it in several parts. Okay,
Right.
Jessica, it's on you.
Okay. Let's go ahead and launch our third poll question prior to finishing up the webinar.
Thank you so much. We've launched that third poll. I'll leave that up for about a minute. All right, give everybody about 10 more seconds. This last couple votes in. All right, we will close and back to you.
All right. As I touched on earlier, and Diane has gone into detail on the USPAP and ISA standards, prior to 2018, no college experience was required to be a qualified appraiser. So we have a lot that have been grandfathered into the industry. These values on non-monetaries can easily be manipulated and inflated. When you don't have someone who understands depreciation methodology, it can often be used haphazardly. And this is an area that is going to receive and is already receiving increased scrutiny by the IRS, as it should be. It is critical to the nonprofit and deconstruction industry that we raise the bar on the appraisal standards. And one of our goals is to reach out and contact other appraisal firms around the country, work with the IRS, and find some good methodology for valuation and finding the fair, well-documented fair market value to be used. So Form 8283, as I keep referring to, this is the actual form that is filed with the IRS to deduct the property and any other non-cash contributions. If you do not attach Form 8283 to a return and complete Section B, the deduction will not be allowed unless your failure was due to a reasonable cause. And as CPAs and enrolled agents, we know that it depends on the day for what is actually a reasonable cause. If you don't attach Form 8283, you must submit within 90 days or the deduction will be automatically disallowed. So all of us tax preparers in the industry, let's remember to make sure that that 8283 is attached for non-monetary. And a separate Form 8283 is required for each item or contributed property that is not part of a group or similar items. So if there are different donations to different nonprofits, and one is building materials and another one is furnishings and fine art, there needs to be separate 8283s on file for the IRS. So what happens when the IRS reviews appraisals? We need to be transparent with our clients who are taking non-monetary contributions. Yes, the nonprofit industry needs these contributions to continue to fulfill the amazing missions and the things they are doing for those in our society who are in greatest need. What our responsibility as CPAs, enrolled agents, and as appraisers is to make sure that we are doing these accurately for the taxpayers. The IRS may accept the claim value of the donated property based on the information provided, or they may make its own determination of the FMV. In either case, they can contact the taxpayer for more information, refer the valuation problem to a service appraiser or valuation specialist, refer the issue to the Commissioner's Art Advisory Panel if it's an art appraisal, or contract with an independent dealer, scholar, or appraiser to appraise the property when objects require appraisers of highly specialized experience and knowledge. So when they review appraisals, the IRS is responsible for reviewing appraisals, but it is not responsible for making them. Supporting the listed FMV is the client's responsibility. The IRS also does not accept appraisals without question, and they do not recognize any particular appraiser or organization of appraisers. So there are penalties. These need to be reviewed in depth with our clients prior to their making a non-monetary contribution. There's the 20% penalty if the underpayment of tax, if the value or adjusted basis claimed on the return is 200% or more of the correct amount, and the underpaid, the individual, the client underpaid their tax return by more than $5,000 because of the overstatement. So we have the 20% pool, but this jumps to 40% penalty if the value or adjusted basis claimed on the return is 400% or more of the correct amount and underpaid the tax by more than $5,000. So this is where we need to dive into this as a tax industry and as an appraisal industry to ensure that we do not have inflated appraisals going out there. These appraisals and the abuse and the potential for abuse in this industry could make these appraisals go the way of the boat and the vehicle donations, which due to misuse and greed are no longer able to provide the support to nonprofits that they needed. So this is yet another reason why I dove into this role, is because it is critical to the mission of so many of these organizations. If I can just share a little bit personally about myself, I'm the mother of 5 children, and one of our sons is an amazing young man. We adopted him out of foster care in Chicago, and he is going to be part of a workforce development team for life. That will be how he is trained to become a plumbing apprentice. He has a cognitive disability and severe mental health issues, so regular education is not applicable to him. He won't ever be able to read or be able to count past 10, but these amazing nonprofit workforce development programs can train sons like mine to make great contributions. So I have an invested interest in this industry. I need to make sure that I work with as many tax preparers, government entity boards, the IRS, and appraisers to make sure that we raise the bar on these appraisals and make sure that they are accurate and conservatively valued. We need to look at the effective date of a property contribution to a qualified organization. This is the date on which the transfer of ownership occurs. We also need to dive in more with legal and tax attorneys to make sure that the transfer of ownership is complete and is substantiated. So there's also the question of donating to a qualified charitable organization. The IRS has a great online portal for the tax-exempt organization search to determine the organization's status. That's a great first step in serving our clients, is to make sure they choose a nonprofit that is qualified. There are some examples here of deductible charitable contributions. So money or property, these are churches, synagogues, federal, state, and local governments, 501c3 nonprofit schools and hospitals, Salvation Army. So these are some general guidelines that you can go back to refer with your clients. Non-deductible organizations, groups where the purpose is to lobby, run for personal profit. Foreign organizations, there are some exceptions to this that is outside the scope of this presentation, but within Canada, Israel, and Mexico, there are charities that have reciprocity. So that is something worth looking into for our clients if need be. you can't give to an individual. They are not a 501c3. Cost of raffle, bingo, or lottery tickets, dues, fees, or bills paid to country clubs, fraternal organizations. Tuition is not deductible. The value of your time and services or blood given to a blood bank. This is one that I actually was somewhat humorous when I had a client a few years ago that had valued that in the high tens of thousands of dollars on Schedule A, and I had to go with my gut on that, that after research, that just was not deductible. So the TCJA, what changes affect charitable contributions? So cash donations, like I mentioned earlier, increased from 50% to 60% of AGI. Non-cash property stayed the same. It is still limited to 50% of AGI. Carry forward period remained at 5 years. However, this is the kicker. The overall limit on itemized deductions for which charitable donations are a part has been suspended for tax years 2018 through 2025, and total deductions will not be phased out. So, as CPAs, tax preparers, enrolled agents, this is one of the few malleable parts of the Schedule A as far as tax planning strategies. The SALT limitation cap at 10,000 affected a lot of our higher with our clients that are in those higher taxed states. There is medical, which it's rare when I have clients that hit that AGI, the 7.5. This is an area where tax planning strategy is going to lead to more non-monetary contributions. Nonprofits need to continue to use this this carrot of tax incentivization for their clients, for donors. So they will donate to these nonprofits these goods that are so badly needed by so many around our country, not just in our country, but we also have nonprofits that are shipping things to disaster relief areas overseas and getting goods to third world countries. So this change in the tax law means that we are going to have more high income donors looking at potentially donating non-monetaries, personal property and materials. What this also means is that the IRS is going to be scrutinizing these closely, as they should. So all of us need to work hard as an industry to make sure that these are shored up and these appraisals are conservative and accurate. Here's a list of resources that we drew from. Quite a lot of information there. The IRS has some great publications that you can dive into in detail with your clients. And our green donation consultants, why it is a good choice to call us. I am happy to talk to anyone. We do not charge a fee for talking and consulting and spreading and disseminating information within this industry. We want to educate. The only fee that we charge is to clients for appraisals. So we work to collaborate with nonprofits, determine through a database system of who needs what in the country and how we can best serve these nonprofits. This is the only appraisal firm that is headed up by myself being a master's in accounting and a CPA, and then my partner, Mayor Dankara, who has the master's in construction management from Texas A&M. And then Diane is our lead appraiser, and she has some of the best experience in the industry. And we have procured a staff of 20 now to research and fully document these appraisals. And we are going to just continue working these 80 to 90 hour weeks until we can have this green mission launched around the country. Here is my contact information. Again, don't hesitate to reach out to me, call, text, email. I have 5 children. They are the hard work. This is the fun work in my life, is diving into my accounting, tax, and now this position with Green Donation Consultants. Before we finish up, if we could launch that last poll question, that would be fantastic.
Thank you, Jessica. All right, we will launch that now. 4th and final poll. And I also just posted Jessica's contact information so you can reach out directly. All right, we'll give everybody about 30 more seconds, make sure everybody's a chance to respond. All right, we will close. We're getting a lot of really great feedback, very informative. Great session. Thank you so much. Some people are asking about the handout. I'll repost that.
Yep, and we have some great additional handouts in the section that have some examples of the donation and appraisal process that we go through. So please don't hesitate to reach out and ask any questions.
And all those handouts will also be available in your account. They're there right now, so when you check back in later to fill out your information for your CP, that will be available as well. So it says, well done, appreciate the additional handouts. Thank you, very informative. So thank you so much, Jessica and Diane. We really appreciate you being here.
Great, thanks so much for having us. And please, again, reach out, any questions you can have. I'd love to initiate more discussion on this.
Perfect, thanks again. To our audience, thank you so much for attending. There were a lot of questions. Unfortunately, not enough time. There's a big class here today, but we will be sending all those questions over to Jessica and Diane a little later today, so they'll still be able to respond. And of course, you can always contact them directly with a phone call and email address right there on the screen. We'll do our best to get your CP process. You should see it in your account by tomorrow. We also recorded this session. We'll make that link available to you in the post-webinar email. Thanks so much, everyone. Hope to see you all at future webinars.